Here's a sentence you've probably heard 100 times. Just buy an index fund. Don't pick stocks, don't time the market, don't pay some advisor 1% a year. Just buy the whole market and let it ride. And honestly, most of the time, that advice is right. It's backed by decades of data. It's beaten the majority of professional fund managers. It's simple, it's cheap, and for most people, it's genuinely the smartest default. But here's the thing nobody in the index fund crowd wants to say out loud. The argument gets repeated so often, so confidently, that it's started to calcify into something closer to religion than strategy. And when any idea becomes untouchable, that's usually exactly when it's worth touching. So today, I want to do something a little different. I want to steelman the index fund argument better than most of its defenders do. And then I want to show you the actual cracks in it, the parts that are true, but quietly left out of the conversation. My name's Jordan. If you've ever felt slightly bullied into an investing opinion just because the math says so, this one's for you. All right, let's start with why the index fund argument is genuinely stronger than most people realize.
The core claim is this. Over long periods of time, the vast majority of actively managed funds fail to beat a simple, low-cost index fund after fees. And this isn't a cherry-picked stat. It shows up study after study, decade after decade. Roughly 80 to 90% of actively managed U.S. stock funds underperform their benchmark index over a 15-year period. Now, here's where it gets really interesting. Most people think this happens because fund managers are bad at their jobs. That's actually not the main reason. The real reason is structural. Every actively managed fund charges fees, often 1% or more per year, while index funds charge a fraction of that, sometimes as low as 0.03%. Over decades, that fee gap compounds into an enormous headwind. A fund manager doesn't just need to beat the market. They need to beat it by more than their fees cost you every single year, forever. And almost nobody does that consistently. Let's put real numbers on it. Say you invest $10,000 and leave it for 30 years. In a low-cost index fund charging 0.03% a year, averaging an 8% return, you'd end up with roughly $99,000. In an actively managed fund charging 1% a year, even if it matched the exact same 8% gross return before fees, you'd end up closer to $76,000. Same market, same underlying performance, $23,000 gone just to fees. That's the part of the index fund argument that's completely bulletproof. Fees compound against you relentlessly, and most active managers don't overcome that gap. This part of the argument, frankly, deserves to be repeated as often as it is. But here's where the argument starts to get weaker than its supporters admit. The first crack is survivorship bias in the data itself. A lot of the studies showing index funds beat 80, 90% of active funds only count funds that still exist today. Funds that performed badly enough get shut down or merged into other funds, and they quietly disappear from the sample. Which means the comparison is often measuring index funds against the active funds that survived, not against all the active funds that ever existed. The real underperformance gap is significant either way, but it's usually a little less dramatic than the cleanest version of the stat implies.
Now, you might be thinking, okay, but even accounting for that, index funds still win most of the time. And that's true. But here's the second crack. And this is the one almost nobody in the index fund crowd wants to engage with honestly. Just buy the index assumes there is one obvious index to buy. And in practice, there isn't. Do you buy a total market index or an S&P 500 index? Do you include international stocks or just US markets? What percentage in bonds? And at what age do you shift that percentage? Do you rebalance quarterly, annually, or never? These aren't small details. These are asset allocation decisions. And asset allocation, not fund selection, is actually the single biggest driver of your long-term returns and your long-term volatility.
The index fund argument sounds like it eliminates decision-making. In reality, it just moves the decision-making somewhere else, into questions that get almost no airtime, because they're less flashy than beat Wall Street.
Here's the third crack, and this is the one that actually matters most emotionally, not just mathematically. Index funds go down with the market, all the way down. In 2008, a total market index fund lost around 37% of its value in a single year. In early 2020, markets dropped roughly 30% in about a month. An index fund doesn't protect you from that. It's not designed to. It's designed to capture the market's return, and the market's return includes every crash along the way. For someone with 30 years until retirement, that volatility is genuinely just noise in the bigger picture. But for someone 5 years from retirement, watching a third of their portfolio disappear isn't a math problem. It's a life-altering event. And just buy the index and hold is much easier advice to give than it is to actually live through when your retirement account drops 6 figures in a matter of weeks. This is the piece that gets flattened in most index fund arguments. The strategy is mathematically sound across the full timeline, but most people don't experience their investments as a full timeline. They experience it one gut-wrenching year at a time. And a strategy that's correct in theory, but unbearable in practice, isn't actually as simple as its supporters claim. Now here's the fourth crack, and it's the quietest one. Index investing works because most people don't beat the market. But that only stays true if most people keep believing that and keep investing passively. If literally everyone switched to indexing and nobody did any actual research on companies, prices would stop reflecting real information, and markets would become less efficient, not more. The current system works partly because a minority of active investors are still doing the work of price discovery, and the majority get to free ride on that work by indexing. It's a strategy that depends structurally on not everyone using it. That's not a reason to abandon index investing. It's just a reason to stop describing it like some universal law of the market, instead of what it actually is, a strategy that works extremely well, specifically because most people don't examine it too closely. So, where does this leave you? Here's the honest version. For the vast majority of people, low-cost index investing is still the single best default. The fee math is real. The long-term data is real. If you're not going to spend real time and effort actively managing your investments, indexing beats almost every alternative you could reasonably choose instead. But treat the parts that actually require thought as real decisions, not settled facts. Your asset allocation between stocks and bonds, your split between US and international markets, your ability to actually hold through a 30% drop without panic selling at the bottom. These aren't details to skip past on your way to the just index conclusion. These are the decisions that determine whether the strategy actually works for you specifically. And be honest with yourself about the emotional side, not just the math side. If a market crash would genuinely wreck your ability to sleep or make good decisions, that's worth planning around directly, through your allocation, your timeline, your cash reserves, instead of just repeating "stay the course" and hoping that's enough when it actually happens. Because the index fund argument isn't wrong. It's just incomplete the way most people repeat it. It's stronger on the fee math than most critics want to admit, and it's weaker on the human side than most supporters want to admit. Both things are true at once, and knowing both is what actually makes the strategy work for you, instead of just something you repeat because everyone else does. If this made you think differently about advice you've heard 100 times, hit subscribe. And tell me in the comments, have you actually built out your asset allocation on purpose? Or did you just pick an index fund and call it done? Because that gap is bigger than most people realize.